Ridham, please explain to our viewers and to everyone what is going on.
Yeah, I know. I think the thing that we're all dealing with is what we call in statistical parlance as tail risk. And the problem with tail risk is that one doesn't know exactly the quantum of damage or when the damage will get over. Now, when equities as an asset class deals with these two types of uncertainties, it is not willing to be rational. In fact, the rationality is that it actually does not think that any price is worth buying. So until that uncertainty settles, the market is unlikely to actually behave as we would call it, quote unquote, rationally. So I think what we're seeing on the screen is just reflecting the fact that we're dealing with a very uncertain environment where we don't know what could be the extent of downside to growth or the time that we may actually end up suffering.
Does one figure out, Ridham, the selling is overdone, or the fundamentals will crack more and markets will crack because fundamentals will crack more?
That's obviously the biggest debate right now. So here's how I look at it, Nikunj. You stand back and you look at valuations. And obviously, you can't look at P ratios because we don't know where the earnings are going to be. So usually in such situations, I tend to look at price to book. It's a far more stable and a reliable valuation measure. I look at how equity yield compares with bond yield because that also, I think, on a trailing basis, equity yield is a known number and the bond yield is a known number. So we deal with such valuation metrics. And where we are, if this is a run-of-the-mill type of situation, like we saw, say, during demonetization or during 2013 when we had the Fed taper tantrum, then valuations are sitting at levels at which, if you buy stocks in 6 to 12 months, I think you'll look back and say that was a smart thing to do. The other thing we look at is sentiment. Now, I have a host of sentiment indicators I look at, like value at risk, like implied vols, like realized volatility, like flows, etc. And we all put all of them into a black box, and we generate something what we call as our proprietary sentiment indicator. That number, as of this morning, is actually worse than it has ever been in this century. It was worse off only in the 1998 Asian financial crisis. So essentially, we're dealing with the second worst reading on our sentiment indicator since I started it going back all the way 30 years. So both on valuation and sentiments, what stocks are telling me right now is that if you are patient, if you have the courage, if you're willing to sit and watch the short-term mayhem, then it's possible that in a year from now or in 6 months from now, you will look back and say, that was a great time to buy. Now, that doesn't mean that stocks don't fall in the next month. I mean, the likelihood is that they actually fall rather than rise because of the punishment that they have suffered over the past few days. We all know that when there is so much of punishment to stocks, it takes time for a bottom to be formed. Either time or price, both could be bad in the near term. So in the next month, we could be well lower, but I do feel that from where we are, just on the basis of what's happening to sentiment and where valuations are, on a 12-month outlook basis, I think things could actually be quite attractive right now. Now, of course, having said that, as I said at the outset, this is a tail event. It's not an event which is normal, and therefore, there is pertinent risk to fundamentals. And just in case, the virus spreads even more and spreads more vigorously, then obviously, we'll have to reassess. So I think for retail investors, the strategy is continue doing your systematic investment plans because you will catch this level and it will get averaged out. For traders, I think they're better off using their own judgment rather than me saying anything because everybody has their own trading strategies.
Ridham, it's often said on Wall Street that you should not fight the Fed. Central bank policy action has kicked in and markets are ignoring that. Why is that?
Kunj, this is the difference between today and 2008. In 2008, when the crisis hit the world, the Fed as well as the government, not only in the US but around the world, had a lot more ammunition at its disposal. Remember, we were coming out of a very strong economic cycle. India's own fiscal deficit was at multi-year lows. In fact, I remember in 2007-8, we almost hit a primary surplus in our budget, which we have never done in the history of this country. Okay, and even ever since then, also we have been running a primary deficit. So that was a lot of ammunition that the government had. The Fed rates were a lot higher when the crisis came, so they had enough room to cut, and they went all the way down to zero in 2008 and stayed that way until 2015. Unfortunately, in 2020, there's not that much ammunition, because we've really not got a major bull run in economies around the world. So the Fed has not been able to hike rates enough. If anything, they're actually already cutting interest rates, right? So they've already been saddled with a slowing economy for multiple reasons. We had the trade war, and we've had other things that have happened. So as a consequence, the Fed has all of just 125 basis points, and even QE is not something that is that is likely to be as effective as it was in 08, because the Fed balance sheet is also expanded. So granted, you don't fight the Fed, but is the Fed as strong as it was in 2008? And I think that's a debate.
Ridham, FIs have started selling. They're already, they own, I think, 25% of free float, and they've already started selling. If this gets worse, where is the support going to come from? What's the kind of change you see in ownership patterns?
See, again, as I always say, flows are a lagging indicator. They don't lead the market. Price leads the market. When the prices recover, the buying will be back. So prices recover when the strength of the offer weakens and the bid comes back. And the bid is really a function of smart investors coming in and saying, this is the price at which I want to pile in. Also, you need some triggers, some sense that the viral load has stabilized, some sense that policymakers are drawing some success. So hopefully these things will emerge over the next few days. It's impossible for me to actually predict when and how that will happen. As I said, this is not an event that we are used to dealing with. There's a lot of uncertainty around this. So, I remain focused on price rather than trying to forecast when that will happen. And, if the price is telling me this is a good level at which I can engage, because the long term obviously is not changed and this business is not affected by the virus in the medium term, then I go and buy that business. As Warren Buffett has said, what has happened over the past few days has probably not changed the long-term cash flow of several businesses, but the price has. And therefore, I think you exercise that judgment and buy such stocks. And again, you keep some ammunition on the side. I don't think you go all in today, because I do think this will take a little while to settle down. So it's not like, we're going to get a V-shaped recovery tomorrow morning. We may get a lot of trading rallies, and a lot of pain will have to get, to flushed out. So markets will keep coming back to give you an opportunity. So we did write a research note yesterday that, we're cutting earnings. We have cut earnings, reflecting a slower economic growth globally as a consequence of the virus. But our price signals, both valuation and sentiment, are suggesting that stocks are worth engaging right now. But I don't think you go all in. I think you do it in a cautious manner.
Understood. Ridham, for the bulls, though, what, according to you, would be the out of jail card from this situation?
See, I think China has shown that there is a way to control the virus, and the way to control it is complete isolation. And the good news is that we have now started isolating. I think the administrations and governments around the world did not panic early enough, and maybe they should have panicked a month ago. But now I think there is some sense of panic. So we've seen the U.S. ban Euro travelers into the U.S. India has also done its thing by putting a bar on foreign travelers into India, and has issued a strong advisory against people traveling. As people disengage, as they cease doing physical contact, I think like we saw in China, we saw in Singapore, quarantining and isolation helps, because the virus can only spread from a human being to a human being. So if humans don't engage, then suddenly I think the viral load stops. So I think that's what we have to watch out for. This panic that is happening in terms of government reaction, I think, is welcome, and it does help a long way in stemming the spread of the virus.
Ridham, with each crisis, we've seen that there is an opportunity and market they tend to reboot. Post 2000 TMT crisis, infra made a comeback. When infra stocks peaked out, consumer stocks made a comeback. Do you think right now a new sort of dimension to the market would be given where consumer stocks, good quality, expensive, cash efficient companies will take a backseat?
So I think, it's a little early for us to actually predict. What I think will happen is that, good businesses, I think, will make a comeback much faster. And then I think we can go into businesses that are not so good enough. But right now, I think the problem this market has had over the past few years is that good businesses have been very richly valued and did not offer attractive prospective returns. Suddenly, a lot of those good businesses are now selling much cheaper. And I dare say that some of them have actually turned cheap enough for us to actually look at them. So what the virus has given us is an opportunity to buy some really good businesses, high-quality businesses, good balance sheets at much more attractive valuations where the prospective returns are looking better. So I think we're better off doing that first, and then worrying about what the next cycle will bring to us and what will be the next big sector. I think we'll have enough time to think about it. But right now, I think the best thing is to go and buy these businesses, which are a whole lot cheaper than they were, say, a month ago.
Ridham, why are markets not paying attention to the decline in crude? I mean, it's lost in there somewhere. We've seen an impact on crude prices themselves, but this is going to have a far more long-reaching impact.
I think that's a very good question, and I think the reason is that India was dealing with its own problems over the past few months, and we were actually just coming out of that problem. This is actually almost very unfortunate for India at the point of its own cycle. So we've seen policymakers work very hard to turn the economy around. A lot of stimulus has been put into place. If you see the February numbers, I mean, the services PMI was at a 7-year high. Manufacturing PMI was just off a 7-year high. We were making very good progress on the economy. And unfortunately, the virus has actually, I think, hurt us at really the wrong time. So we were just coming out of bed, like a sick person coming out of bed, and he or she got hit by another sickness. And that makes us particularly vulnerable. People think that India is isolated from the global economy. It's not. 20% of our GDP comes from exports, and we are going to hurt because the global economy is now threatening us. And what we needed in 2020 to completely heal was a stable global economy, and that was taken away from us. So for sure, the fall in oil prices is great news on terms of trade, and it will help India in the medium term if oil remains weak. But right now, I think we have to worry about what happens to our very, very fragile and nascent growth cycle, which was just kind of turning around and was looking like making amends, and now it's been, kind of pushed back a bit.
We've taken a lot of your time. I know you need to get back, so I'm going to just close it up with one more last question, which is, what happens to consumers? There will be a slowdown there, and they are expensive. So what happens to a pocket which is stretched in terms of valuation, and a slowdown is going to be profound and real?
Actually, Nikunj, I'm not that worried about the consumer in India. So now the only reason why you would get worried is if India itself experiences a spread of the virus. So far, India has been quite resilient, and we have tried to dabble into the reasons. And frankly, I don't have the expertise to completely explain this. But maybe it's a combination of many things. So one is the testing capacity in India is very low. So rate of incidence is directly proportional to testing capacity. So it's quite possible that a lot of cases go unreported because ultimately the symptoms are not very different from flu symptoms, right? So we don't even know that there are more COVID cases in India. Then the weather, India is a whole lot warmer. Somebody says, Singapore is also a whole lot warmer, but then India doesn't use air conditioning. And viruses do struggle in warmer weathers. I do think that the fact that India uses lesser flu vaccines is also a factor. The fact that we travel a lot less internationally is also a factor. The Chinese travel a lot more. 5 times more than India, 10 times more than India, also have a lot more inbound travel. So I think all these factors have helped India stem the virus so far. Thankfully, I think the government is now taking very aggressive action to make sure that 60 doesn't become 60,000. And so if the virus doesn't spread in India, then I think Indian domestic consumption will be okay. If anything, actually, it will make a comeback. Of course, the caveat here is that we don't see a sharp slowdown in global economy, which then brings fresh job losses because the export sector suffers. So again, I'm making those assumptions and we don't know exactly where they go. So I would be a little less worried about consumption right now, but we'll keep an eye on that and see how things pan out over the next month or two.
I really hope next time when we speak, we are speaking about better days and better levels and better mood in the market.
Absolutely, Nikunj. I'm absolutely convinced that it will happen. It's a question of time. If you're a long-term investor, I think you've been sent an opportunity to buy stocks, and I think you should start looking at them. Of course, keep ammunition on the side because you may get lower levels, but you can't ignore the fact that prices are looking a whole lot attractive than they were, say, 3 months ago.
Example, Ridham, which we're using every day is that do you bake a pizza in this market or cook your dal makhani? Pizza is instant gratification, dal makhani, pain first, gratification later. So go for dal makhani, right?
Yeah, always in equities. It's the longest duration asset class in the world. Instant gratification is a very bad idea.
All right, Ridham, appreciate your time. In case, really appreciate your time. In case you've just were glued onto a screen trying to understand that, what's happened to market in the last 5 minutes, well, we've stopped falling. And,
trust me, it's nothing to do with me.
All right, I appreciate your time, Ridham. Fantastic to have you.
Thank you, bye. Bye.